Hello and welcome. You're watching a very special telecast we've planned for our viewers today, which is called The Stock Pickers. On this occasion of Dhanteras and Diwali, we at ET Now wish all our viewers a very season's greeting and a very happy Diwali. The Stock Pickers, three special gentlemen are joining us on the show. People who have seen the cycles, are very much deep inside the process of stock picking and investing. I'm talking about Manish Sonthalia, who joins us from Motilal Oswal, Prashant Khemka of White Oak Capital, and Samit Vartak from Sage One. Gentlemen, all three of you, thanks so much for joining us today on this very special Diwali programming called The Stock Pickers, and wish you all a very happy Diwali as well.
Wish you, the entire team at ET, as well as all the listeners, really blissful and satisfying Diwali and very rewarding for the next year.
Happy Diwali and best wishes for a healthy and prosperous new year.
Right, Manish, let me start with you. You're running one of the largest PMSs in the country. You've seen so many cycles. First of all, I'd like to understand from you, because the name of the show and the theme is stock picking. How has it been for you over the years, seeing the cycles, especially this one, which was very short but very rocky? What have been your lessons of, navigating through peaks and troughs? Talk to us about things which you have learned on the way, which our viewers can also learn.
See, I've seen the cycle of 1992, 2000, 2008, and now this one. So as is with every cycle, these cycles turn. And the more the V-shape, the more the sharper the fall, the more the V-shaped recovery is. So nothing really has changed between, let's say, March and now, except for the fact that there's some bit of optimism regarding vaccine coming sooner than later, let's say within the next 3 to 6 months. Nothing has changed as far as the earnings are concerned, and the amount of fear that was created post Q1 numbers regarding the rest of the quarter's numbers. I mean, we are looking at the Q2 numbers. They are nothing close to what analysts had predicted. So we are shocked with the earnings recovery that we have seen. So it brings to light that India is a resilient economy, and doomsday scenarios don't last too long. And these are God-sent opportunities if they come, and one should be wiseful enough to actually pick up on stocks whenever these sort of opportunities arise. So I was really not too much perturbed. In fact, we had been advising clients to lap up on stocks, even though it was falling one way on the down. But we were quite sure that sooner than later, this sort of recoveries would come through.
Right. Manish, how are you analyzing the landscape right now, looking at economic indicators, quarterly earnings, talking to managements? How fertile do you see the landscape now, if one were to take a 2 to 3 year view, to really hunt for high quality potential multi-baggers? What is your homework telling you right now?
So with the amount of printing of money that has gone through, some 17, 18 trillion dollars worth of stimulus, India will also get its share. And, the fear factor which was there was conducive for defensives. When risk on trade comes back, it is conducive for cyclicals. Right now, risk on is back. We are looking at a vaccine scenario 3 to 6 months down the line. And this is a build-up to the risk on scenario. So whatever has not done well in the last 3-4 months, namely the banks, which have still been underperformers, I think they are going to come back with a big bang. Rest is with rest of the cycles. You had migrant laborers going back, so construction names, etc. These are also very important part of the economy. They will do well. While those that have performed very well, the likes of, let's say, the farmers or the consumer names, might just take a breather for some time. But if you were to take a 1 to 2 year view, I think there are 5 sectors which look good. These would be your consumer, these would be your IT, pharma, these would be your telecom, and a bit of banks, particularly in the private sector space.
Manish, talk to us, what kind of work are you doing right now in the backdrop? What kind of companies are you really looking deeper into, companies which have shown resilience in earnings, where the visibility seem to have improved, and where the earnings actually could have meaningful upgrade in the next 2 to 3 years? For our viewers who can take a view of between this Samvat and the next one, or even beyond that, what does the potential look like?
See, automobiles have not done well at all in the last 2-3 years, and now with BS6 and all these things behind us, I think automobiles is one space which is going to bounce back with a bang. And if you analyze automobiles and you see that paint companies also doing well, obviously there's one name, Kansai Nerolac, which has a lot of exposure to automobile paints. They have not responded yet to the numbers. The numbers have not been as great as that of Berger Paints or let's say Asian Paints, etc. So these are some of the potential names to look at. The banks have been beaten down maximum. You have seen a 30% cut. Obviously, moratorium, we'll come to see how the NPL situation plays out once the December quarter numbers come through. But there's a great potential in banks, particularly some of the high quality banks which have been beaten down way beyond expectation, and particularly so in the mid and the small cap space. Large cap banks, clearly there's a differentiation. Now it's between Kotak, HDFC and ICICI Bank. You got to pick and choose between them. But there's a lot of opportunity in the mid and the small cap bank names. Similarly, you have some of the insurance companies. Some of them are flying through the roof. Some of them are not getting the desired valuations due to one factor or the other, merger with Axis Bank and so on and so forth. These are some of the names. So cutting the story short, companies which have reported decent numbers, but the markets are not reacting to them. I think these areas present a great opportunity for stock picking going down.
Right. That's very interesting. Beaten down private sector, mid-cap banks and infra names is very interesting, something our viewers can munch on. Manish, gentlemen, Samit and Prashant, all three of you stay with us. We'll take a very short break here on this special telecast called The Stock Pickers, and we'll come back and discuss more ideas and more investing thought process to navigate the cycle which seems to be turning in the direction of upwards move. Don't go anywhere. More on the other side of the break. Welcome back. Still watching The Stock Pickers right here on ET Now, the Diwali special offering of ours. Manish Sonthalia, Prashant Khemka and Samit Vartak are our stock pickers to talk about markets and the investing style. Samit, Manish spoke about beating down mid-cap banks which look attractive, some of the contra calls on the infra space as well. Let's talk about your style. First of all, being a somebody, how have you navigated the last couple of months? How are you analyzing the investing environment now? Is it ripe? Is it time to go into the mid-caps right now? Is the rally expected to broaden? What are your thoughts there?
Sure. So, yeah, I think, this year has been such a drastic year. There were a lot of learnings. So it does, at such times, when there are happy times, you need to sort of evaluate, how things were, what went wrong. And it's time to, take stock of things. So I think what has definitely been a big learning, or not just last 1 year, but also last 5 years, and which would help you, generate a lot of wealth without too much of pain. So I would just list out things which I've learned not to do. There are, in any cycle, there are too many of such exciting turning points that you will see. There are a lot of hope trade. Like today, people think, it's, many call it the start of a new bull run, like 2003 kind of times. And unfortunately, no one knows, whether it will be that kind of a time or not. But in a cycle, every year you will find people claiming to be such times. So my learning is that do not fall for the rhetoric, do not fall for any kind of a macro trend, because most of the times you need to be really lucky to get it right. So it's better that, see, if there is a real macro trend which is going to start, then that trend lasts for 5-7 years. You are okay even if you let go of few quarters of real change, because if there is a macro trend, you will find stocks which will go up by 5x, 10x, 20x, 50x over the next 5-7 years. And even if you let go of initial 50%, 100%, you are not going to lose a lot. At least you will have peaceful, because if you go for such trends all the time, you will realize that your portfolio is made of so many failed themes, and most times it doesn't work out. So for me, because I'm a stock picker, I want to see some proof on ground that things are improving, and only when they start playing out on ground, let it have some time to get some confidence, and then jump into it. So unfortunately, many a times, people will get excited. They want to preempt everything. They want to forecast that, let me get into the theme before it's too late. It's not going to be too late if a real theme starts. Let few quarters go. Stick to themes which are already playing out, which are already, you can see it on ground. That way, at least you will not lose money.
Samit, that's an interesting point, and our viewers should take note of that. Despite of everything appearing very buoyant, one should not ignore the homework, should be careful, go deeper into the numbers and thesis, and then only make the investment call. I like your cautious and careful approach to the market. But still, what's on your drawing board? What themes are you researching which have potential for outsized gains in the next, between this Samvat and next, or maybe next 2 Samvats? Talk to us about slightly more specific areas.
Sure. So yeah, I'm not going to repeat the same themes, which I have been talking about, like specialty chemicals and, pharma and CRAMS and contract manufacturing, because I think those are pretty well-known themes, and I think people, already positioned for that. It seems it is already factored into the valuation. I think where I'm seeing on ground is where there is already some momentum building up is the building material. Because there are these PLI schemes, there is this manufacturing incentive of low tax rate that is going to spur demand for building factories, building some infrastructure, and there will be building material which is needed. You can see it in steel, cement, tiles, pipes, structural steel pipes, PVC pipes. I mean, look at the results which have come out. They have all expanded margins. Plus, there is some incentives for even exporting because of the trade barriers on other manufacturing locations. There is incremental demand which is coming out of that. But I want to bring in one more point where a lot of times, even if you know that this theme is playing out, there are many indirect ways of playing it out. Like straightforward way will be bet on cement or bet on steel. I don't think that's where you make those multi-bagger kind of returns. I think look for indirect plays. So for example, if steel cycle picks up, or
Samit, let me come over there. We're slightly short on time. I would like, from your rich experience of being a professional fund manager for 10 years, navigating in the mid caps, running the fund, which is scaled up quite nicely, and in your previous avatar of working overseas, looking at valuations globally, what are some of the lessons you would have for our viewers to become better investor?
Right. I think one thing that needs to be put into your mind is that it's very difficult to time the market. Once in a while you will get lucky, and there is going to be disconnect between the markets and then the reality on ground. You will never find them coming together. Unfortunately, because last 4-5 years we have seen so many shocks one after another, where the markets go up and then you take a beating and you lose whatever you have made in the past. And that's what is the fear in the market. And during any real upturn, where there is a turning point, investors will really fear to think longer term. I think it's always better to look at the fundamental valuations rather than going by how much the markets have gone up. I mean, when I look at large caps, yes, large caps have gone up, but today mid cap and small caps, if you leave out the top say 250 stocks or so, the valuations are in the midpoint. 18, 19 times is very easily you get really good quality companies. The range for this space is from 10 times to 30 times. So if you are getting it at reasonable valuation, there is no point in trying to time the market, because you will never know when this big upturn starts, and most of the money is made in such a short period of time. I've said, I've told it, I've written it in my memos that in every cycle you have 15 to 24 months between which most of the money is made. The remainder of those 3-4 years are flat. We have already seen those flat years over the last 4 years. And I believe that if there is turning point, then you got to be in the market. And especially if you are a stock picker, those jumps are pretty ferocious. It's market may go up by 100x, 100%, but there will be many stocks which will go up way above that. So whenever the valuations are in sort of the midpoint or even a little higher than midpoint, it's better to be completely invested, because in such time you will anyways be hearing so many fearful things. There is COVID, there is fear of a crash, there is fear of too much liquidity, rally because of liquidity. There will be so many things which will get you out of the market. It's better to just focus on the ground, have confidence in your set of company that you've invested in with whatever work you can do on ground, and be confident about those investments and ride it.
Sure, Samit. So staying in the market is more important than timing the market, because it's just not mathematically possible to time the market successfully. That's the word coming in from Samit Vartak. Prashant, you are somebody who's really managed overseas funds. You've been overseas as well, managing emerging markets and India. Now, of course, building your company and becoming a fund manager for your own company at White Oak. How are you analyzing the earnings landscape? Second quarter did come as a surprise to many. Do you see broad-based earning improvement, or that earning cycle upgrade cycle also to start from here on?
I think from my perspective, last 12 years have been very poor, as you would agree, for the earnings for corporate India as a whole, right? Because every year, pretty much like clockwork, all of us, all the market strategists and analysts and CIOs expect, like magic or like a broken record, earnings growth to accelerate to mid-teens or high teens for the next 3 years, starting next year. And for last 12 years, at least, all of us have been wrong. Earnings growth has been mid-single digits or thereabouts. So we are now at a point really that, we've stopped forecasting from a top-down perspective, whether it is going to be mid-teens or high teens at a market aggregate level, but rather focus on what the companies in the portfolio can deliver, I would say, has been where the team's thinking has been centered around. Having said again that, I would say yet again, the hope is for a different reason. Now the earnings have collapsed so much over the last couple of quarters, and this year quite possibly would be down double digits earnings growth, that from a such low base, you are bound to see a strong rebound. I'll be very surprised, very negatively surprised if we don't see a strong 20 to 30% growth rate in FY22.
Prashant, I get your point, but how is the portfolio construction looking like for your own portfolio? What kind of themes or stocks which you are betting on right now could make very good, reasonable returns on a portfolio basis and have a good potential to run?
Certainly. So let me give you, a bit about first the conclusion. So the portfolio that the team has built, their expectations is that for that portfolio, in the context of where the market can deliver low double-digit earnings growth, the portfolio should be able to deliver very high teens to closer to 20% cash flow growth and earnings growth as a consequence as well. More importantly, on your other first question, if you will, the themes, we consciously stay away, Ajay, from any top-down macro theme related investing to any significant degree, I would say. because that, in my experience and the team's experience, hardly ever adds consistent value over time. While the themes are in works and at play, you'll get supernormal returns. But then when themes turn against you, and they always turn against you before you realize, and then there's a massive drawdown in performance. So our philosophy is very consciously stock selection driven. We consciously avoid macro bets and macro themes. Having said that, again, the names, some of the sectors that I said, where we find a lot of stock selection based opportunities, they represent a bigger chunk of the portfolio. So private sector financials, particularly mid cap IT services names, some of the healthcare sector names, specialty chemical names. Now, I would not call them themes. Themes are where you have massive chunks of portfolio from a top-down perspective dedicated. That's not the case with our portfolio. There are dozens of, or each stock is a theme in itself, if you will. And so we have a very broad range of stock selection-based composition of the portfolio, rather than very concentrated around a couple themes or three themes.
Prashant, mid-cap IT financials is your call. Great portfolio construction. Talk to us about some of the lessons you would want our viewers to learn. You've been almost 25 years a stock picker. There are a lot of new breed of millennial investors which are joining the market right now, trying to do stuff on their own. A combination, actually. What would you tell them? What would you advise, or some of the lessons they can learn?
Yes, certainly. So, as you reminded me, I started investing about 35 years ago in 1985, personal level, family level, and then I worked for 12 years in foreign markets, developed as well as emerging. One of the lessons, fortunately, while my professional career started from 98 onwards, the most profound lessons I learned making mistakes on my own money or family money. The first lesson in the early period, as well in the 80s itself, I would have learned that timing the market is impossible. If this is one lesson that investors can digest, and stick to, that timing is impossible. It's not very difficult. When you say something is very difficult, you try to imply that it's possible, but just very difficult. But in my view, it's not just very difficult, it's impossible. I often quote the dialogue from Dawn, a movie that I watched around the same time in the mid to late 80s, where they say, Dawn ko pakadna mushkil hi nahi, namumkin hai. While that might or might not have been true for the Dawn, but it's definitely true for the market. To time the market in any degree of consistency that reflects skill is not merely difficult, but it's impossible. So that's one lesson. The most important lesson, I see more retail investors losing money trying to time the market than losing money from just a correction or a bear phase in the market. And secondly, I would also add,
All right, Prashant, thanks very much for that. In fact, Prashant, Samit, Manish, all three of you, thanks so much for joining us on this special telecast called The Stock Pickers, with your advice on what's looking good, how you are managing your portfolios, and some of the lessons for our viewers and budding investors. Thank you so much, and wish you all a very happy Diwali once again. With viewers, I hope you enjoyed the show. Thanks very much for watching. Goodbye.